I think anybody who's got a gold or silver mine will be running it at full capacity, even if the cost of power is, let's say, double. I don't think that's, I mean, obviously it's a factor, but at the end of the day, we've had a doubling of the gold price. We've had a tripling of the silver price. I think anybody, even though they have higher costs coming in, they're going to be running at full capacity to try and get as much as they can out to take advantage of the price at the moment. Let's talk about silver for a minute. We had this huge run up in silver right up until the end of January, and what we now know was happening. We didn't know at the time. We were sort of speculating a bit, but what we now know is a lot of the normal buyers of silver, that would be industrial users like car manufacturers, like solar panel manufacturers, like the electronics industry, and perhaps the defense industry, they almost certainly had a lot of contracts spread over the entire spectrum of the futures from, January, February, March. What now seems to have happened, a lot of those people who moved when they started to worry that they'd run out of silver or wouldn't be able to get their hands on silver, they started to move their contracts forward into January to take delivery, and took delivery in January, which caused the price to spike up right at the end because nobody was expecting so many deliveries. And the shorts got kind of squeezed at that point. So the speculation we had was that March would be the same, but it wasn't. In fact, as we went into the March month, we had a massive decline in the number of deliveries compared with a year ago. And I think that reflects the fact that a lot of the manufacturers had taken this delivery of silver in January, and were now, because they weren't worried they weren't going to get any, now they have stock and they're letting that stock run down. So we've seen a lot of rollovers into the month of May now. I mean, there's a huge open interest in May relative to the amount of silver which is at COMEX. So I think that we're kind of where we probably should be at the moment. But come May, it'll be interesting to see how much delivery is taken. What we do know, as an absolute fact, is the amount of silver at COMEX, both the registered and the eligible silver, both are dropping week after week after week. The amounts go, I mean, I think the amount's probably as low as I've ever seen it, definitely as low as I've ever seen it. So it's going out from the CME warehouses, it's going somewhere, and I think the obvious place it's going is to the manufacturers who need it. The way you move gold out of Dubai, and they export about 20% of the world's gold, is by air. You can't do it by sea or land. That's too risky. And of course, we've had severe disruptions over over Dubai and over the Middle East as a whole, which means that there's far less flights going. So the problem with that means that the people have bought this gold from all over the world, which is going to be flown out, but it's not being flown out. So the people who own the gold now have to pay very high insurance premiums because the risk has gone through the roof. They have to pay storage costs while they're waiting for it to be shipped. So what's happening is that people who own gold, which they should have laid their hands on somewhere in London or New York, wherever it happens to be, can't lay their hands on it. They're incurring very heavy costs by keeping it where it is because they've got no choice. It can't come out. So what are they trying to do? They're trying to unload this gold as fast as they can to stop the costs from running. Obviously, they will plan to buy it back once they can actually get it, or they'll try and buy it from a different source. But at the moment, we've got net unloading of gold in Dubai by those who bought it before this conflict started and now find they can't get their hands on it and have massive costs to pay just to keep it where it is because they can't fly it.
The global financial system may be sitting on a ticking time bomb hidden in the rapidly growing private credit market. Shadow lenders have been issuing highly leveraged and risky loans outside the traditional banking system, often without the safeguards that regulated banks must follow. Now, the first signs of stress are beginning to appear. Some borrowers are struggling to make their interest payments, and major credit portfolios are already facing sharp declines. In some cases, funds have even restricted withdrawals after their value dropped significantly. The bigger risk is contagion. Many of these private credit deals were ultimately financed by commercial banks. If defaults continue to rise, the losses could spread into the traditional banking system and create wider financial instability. Analysts warn this could resemble the early stages of a major credit crisis. If banks face serious losses, governments and central banks may respond with bailouts and large-scale money printing. That kind of monetary expansion typically weakens fiat currencies and increases interest in safe haven assets. As confidence in debt-driven systems declines, assets like gold could benefit as investors look for protection against financial instability and currency dilution. Are you curious about investing in gold and silver but feel held back by fear or confusion? This ebook is designed especially for new investors who want clarity, not complexity. It breaks down gold and silver trading strategies in a simple, practical way. No jargon, no hype. Why wait? Hurry up. Please visit this link to get your copy today and use code DUNDEEPLE for a huge discount. More than 1,000 people took the first step with this ebook, and today they're living proof that smart investing changes lives. Start investing fearlessly, wisely, and with a clear strategy.
In a nutshell, this multi-trillion-dollar private credit market is an amalgam of private equity, venture capital, special purpose vehicles, money market, and hedge fund actors using massive turns of leverage to make risky loans to a predominantly unknown class of borrowers. I call this red flag number one. These private lenders also make loans with none of the capital requirements or deposit insurance or direct Fed access otherwise characteristic of and available to the allegedly safer and more regulated commercial banks. That's what I call red flag number two. Also, these private lenders were already seeing default rates creeping up from borrowers like Tricolor and First Brands Group and other subprime borrowers at alarming rates, reminiscent of those first defaulting subprime mortgage pools we saw in the pre-08 days. So that was red flag number three. Now, borrowers to these private creditors were unable to make their interest payments, and they were increasingly and really desperately offering equity instead of cash to cover their interest expenses. These are called payment in kind or PIK payments, and those trends were an ominous signal of more default ahead. So that was red flag number four. But there was another larger yet more hidden red flag lurking behind kind of these PC curtains.
Do like, share, comment, and subscribe to this channel. Also, don't forget to hit the bell icon for more updates.